The struggle between the world's two foremost powers is entering a new phase. Relations between the G2 nations, the US and China, have become increasingly confrontational over recent years. And now the US is adopting an approach that looks a lot more like that of its main rival. Under the Biden presidency, the US is focusing more on self-sufficiency and competitiveness. The experience of the pandemic has reminded both countries of the vulnerability that comes from relying on imports of key goods. Supply chain squeezes have occurred in multiple products, such as rare earth metals, vital medical supplies, and semiconductors. In the US, we now expect more Chinese-style state capitalism and attempt to build up infrastructure at home, as well as strengthen key technologies such as green energy. In our view, the strategic competition between the G2 nations will intensify as a result. However, we also believe competition, rather than a hard economic separation or military escalation, is in the interest of both sides and humanity at large. State capitalism has certainly boosted key industries in China over the years, as well as the country's overall growth. So what might this all mean for investors? Faced with growing G2 polarization in recent years, we've consistently made the case for global investor allocations with meaningful exposure to both the US and China, or China's regional economic influences. And with the standoff entering a new phase, we continue to see a wide range of potential opportunities. These include the makers of some of the tools that enable G2 competition, such as semiconductors and satellite communications. Companies involved in renewable energy and electrical vehicles also stand to benefit from state capitalism on both sides. We also expect a boost for companies in Southeast Asia that seek to serve both sides in sectors including infrastructure, industrial automation, and real estate. As the G2 powers intensify their struggle, make sure your portfolio is positioned for polarization.